So welcome. You should all be able to see and hear me loud and clear. I know you can. So I'm going to jump straight into the first slide, which is this one, which shows, well, basically who's here in a way. Just give me a second to put that one up. We share the screen and you should be able to see that, and you should be able to see me in the corner as well. Okay, so look, it's important that the audience knows who this webinar is for and who they are, if you see what I mean. Okay, we've got pensioners, we've got everything all the way down then to 20-somethings who they might not have the money today, but they want to learn for the future. We've got people who don't want to miss out with some of the growth we've seen in January. And I'll show you, as I said, what's in my portfolio and also how you should be investing yourself. Then there's, of course, people, and we've got an increasing number of these this year, who are disappointed with their financial advisor. Why should I have an increasing number in 2023 who are disappointed with their IFA or their financial advisor? Well, because in 2022 and in 2021, they saw that in an up market, they didn't do that great. And in a down market, they did even worse. So come 2023, they've had 2 years of not great growth, when actually in 2021, the market shot up and still they saw they were lagging. So we've got a load of those people who are just fed up with those financial advisors and they want to double check the homework, as it were. Okay. Mike is mentioning some people are predicting stocks lower due to increased rates. We'll address that question. Okay, my FA is terrible. I know. Well, I'm going to show you some information on there. UK, complete beginner as well. Ravi, thank you, my friend Ravi, and Anas as well. We've got a whole bunch of people just registering on. Then we've got people who are with boutique wealth managers, and I get a lot of complaints about some of the ones you've seen in the newspapers. The Sunday Times did a story about, for instance, St. James's Place, and they're saying, look, I'm paying heavy fees, I'm just fed up. That's not even an IFA, it's a wealth manager, and I'm just not getting the returns I would have expected. Okay, so we've got a whole bunch of people there as well, to complete beginners. So let's get on with how do we help all of those people, and what do I have as well. First of all, I've got to give you a disclaimer in the sense that this can't be individual financial advice because I don't know you individually. So it is not specific tailored advice to you individually. It is showing you the fish that I've caught, in other words, the stocks that I own, and more importantly, how you should learn to fish for your own risk appetite. Okay. So how should you be picking stocks? That's essentially what I say there. At some point, I will get around to finishing my latest Financial Times book called Forecasting Share Prices, 10 Ways to Make Accurate Predictions. But I'm really bad at predicting when I'm going to get the book finished. I know, the irony of it, yes. Oops, I have no conflict of interest with you. I'm not a retail long-only fund manager. Okay, so I'm not trying to get you to buy my fund, and I'm not a stockbroker trying to get you to use our brokerage services. So my only interest is that if my portfolio does well, then you must be doing well, because if you're looking and learning from me, then you must be doing well. So my interests are aligned with you. We run a private equity fund and we have a hedge fund. It's not open to retail because it's not allowed. You can't have retail in private equity or in hedge funds. So we don't have a conflict of interest with you there. We're based out of 84 Brook Street, though since COVID, I don't go to the office that much. And one of my partners has relocated to Zug in Switzerland due to COVID and all sorts of other reasons, and the other one to Munich. So there's not really much point going in that often. Anyway, that's enough about sort of my background and credentials and pedigree. Let's talk about the S&P 500. Let's start off. Let's kick off with this. Hi, Imtiaz. Great to see you as well. Joao says no sound. Let me know if anybody else has got sound problems. Mike's out of Spain. Yes, I know that. That's good. So where are we with the S&P 500? Now, an amazing thing happened last January. Almost on January the 1st, the market just peaked. Now, that rarely happens, that the calendar aligns with the market. And it continued going down in this downward channel, okay? Continued going down in that downward channel throughout the year. So whenever it went up, it hit the top of that channel and it fell down. This year, almost like clockwork, January the first week, pretty much, it broke out of that channel. Now, is that good positive news? Yeah, pretty much. That's relatively optimistic. But we're not just going to look at the charts alone to determine our stock picks, are we? This just gives me a background indication of how risk averse or risk loving I am. So last year, I ended up by about middle to end of February, so middle to end of January, and then into February, into March, into April, May, and so on. As you will know if you followed my weekly broadcast, I just ended up holding loads of cash. Why? Because I became more and more risk averse as this indicator, the monthly MACD, a technical momentum indicator, was just pointing downwards and downwards and downwards. And it was like, well, I don't want to buy this week. Let's leave it another week. And each week I'd do my weekly update and I'd say, well, still not sure. So by about May, the only thing which looked worth buying, and I was late into it, or April or May, were energy stocks. I was slightly late into them, but they turned out to be okay for the rest of the year. And 80% of my portfolio was in cash. Actually, in hindsight, that wasn't bad. Energy, 20% of the stocks and 80% in cash was pretty good for last year, okay? For this year, it's already become the other way around. 80% is in stocks, and I'll show you which ones, and then 20% is still in cash. Why is it still in cash? Well, I'm not 100% bullish. I'm still thinking, well, you know, this week will probably go a bit lower in the markets, and that's the kinds of things that I look at. I look at this to determine my risk appetite, and I do a weekly update to let people know just what I'm thinking. Now, I'm holding my investments for 12 months, and I'll explain what the rules are, what the key numbers are, 12 months, what the stop should be, should any of them go wrong, and how many you should have, and how you pick them. We'll get into all of that. But I just wanted to give you this overview, first of all. Neil, welcome. You're new from Leeds, my hometown as well. Okay, so this is the overview. This is how I determine the overview, and I really recommend it. By the way, I'm just using a normal retail charting platform. There are many out there. This happens to be something called TrendSpider. You could use Yahoo Finance or Google Finance. And that monthly MACD, that bit you see where it's just falling sharply, it just gives me a background appetite of how positive or otherwise I am. Did you notice how I didn't say, despite having a master's degree in economics, well, central bank tightening, or I didn't say budget deficits, cost of living, higher prices. I'm not here to gamble on macroeconomic news. That should feed in to the price movements here. Equally, I'm not just going to look at price charts. What I'm going to start off with is looking at data. Then I'll worry about the narrative. Now, that's really good advice, whether it's in social media, in life, or in investing. Look at the data first, then look at the narratives of, oh, I heard interest rates are rising. Oh, I heard there's a cost of living crisis. Oh, the Russians will do this or whatever. I'm not trying to outsmart the rest of the market. I'm not trying to be an opinion columnist or a journalist with this. I need to look at the data. So let's look at the data of how we might want to pick stocks. We want a good, simple process because we don't want to be doing this, you know, every evening, do we? We want to limit the amount of time we have to be in front of the computer and analyzing these things. And we certainly don't want to be reading Investors Chronicle I mean, it's a great magazine, but you know, you might not want to be reading it cover to cover every single week. You might think, well, I'll pick it and pick some stocks and now just read for background, or Bloomberg for background information. So where are we in terms of the broader market? Well, these are PE ratios or price earnings ratios. It's a measure of valuation. Red, high price earnings ratio. You know, the share price is relatively expensive compared to profitability. And guess what? Only energy and banks look relatively cheap, and Amazon. So we're not going to pick based on just any one criteria, and the market still looks expensive. You can see why, based on fundamentals or based on charts, I'm not 100% fully invested, and there is an element of some degree of caution. I'm going to share something as we speak on my Telegram channel as well, just so you know how the thinking occurs with these things as well. Okay, and you'll see Morgan Stanley are pessimistic. That miserable git, Jeremy Grantham, who was born miserable, is still pessimistic, but then he is all the time. So I'm not really worried about what he says. So what kinds of things this year am I buying and why? Okay, so I'm going to explain to you in this webinar, and this is still the overview, I'm going to explain to you in the webinar how we look at the fundamentals of an individual company. We want the kinds of companies which, should the market fall, then these stocks are resilient because they're good value, i.e. their share price compared to their profits, their revenue growth, and I'll break all these figures down for you and show you the images and the process you use. Okay, they're delivering good dividends usually. They've got good, strong cash flow. They've got a whole bunch of factors, boxes we can tick. So we're not gambling on, have I picked a value stock? Have I picked a growth stock? Have I picked an income stock? Or, oh, tech sector should do well. That's just too broad a statement. Okay, we're looking at the individual companies. Have they got resilience should the market fall? And should the market rise, then they should do even better. The analogy I always use is think of an airplane flying from New York to London. If there's tailwinds, i.e. the market does well and it's out of our hands, and we can try and guess whether it's going to be an up or down year, but it's a mug's game. But yeah, we can try and guess it. If it's got tailwinds, we should get to London faster, i.e. our portfolio should do better. If there's headwinds, same company, same airplane, same pilot, same financials, would mean the portfolio is not going to do as well. Again, that's the analogy. So we want those kind of stocks, the resilient kind of companies with potential upside. So why NVIDIA or some of the others I'm going to show you? Well, because on the fundamentals, they tick the boxes we should be looking at, which I'll share with you. And I have another rule. I have two other rules. One is, for me personally, and that's up to me, you don't have to follow this rule, is my hurdle rate is, if it's an American company, and most of my SIP and ISA investments are in US stocks, but I'll share with you UK ones as well in a second, because some of you will like UK. I just personally like American ones because they give me roughly double the returns I get from my UK portfolio most years. Last year was a rare exception, and certainly not frequent enough that I ditched the rule that I want US, because I normally, as I say, get double the returns. Why do I get double the returns in the US? I've got more stocks to pick from, and just look at the indices. Okay, over any rolling 5-year period, they just do twice as well. I mean, it's just generally as a rule what happens. Okay, so what were the two other factors? I need a hurdle rate, or I need to be able to look at a stock, and once I've ticked the fundamentals box of value, growth, income, I need to be able to project forward and say, is it reasonable that in 12 months it could give me at least a 40% return? And for that, I pull up the chart and I look at it. After I've looked at all the fundamentals and I've shortlisted the stock, I say, is it reasonable that I get a 40% return? So I look at this and I think, yeah, actually, that is reasonable. It's not guaranteed. It's not guaranteed, but is it reasonable? If I look at that direction of from here, this arrow that I drew, how much would it, that angle, it would have to rise by? Has it done that in the past? Yeah, it's done it here. Look, it's moved at a similar angle of growth. Okay, can it do it now? Yeah, given the fundamentals, it's reasonable. Given that the monthly MACD is flat here and is rising, okay, that's reasonable, because when it's rising like that, it can have those good, strong growths, and it would only be returning to where it was a couple of years ago. So all of those factors suggest the fundamentals, the MACD, the angle of growth, having achieved it in the past, and where the price would be if it gave me a 40% return, all of those things suggest it's reasonable. Okay, that's something new I don't think I've expressed so clearly in the past in my webinar. So that's new and exclusive to you guys. Okay, those are the other factors. I mean, I think I have expressed it, but probably not so specifically. Okay, so let's break that down. Let's break that down into what this webinar is about. What are the factors of value, growth, income, cash flow that we're looking for? And what's the simple process so we decide how long should we hold the stocks? How do we find the information? So how many stocks, how long do we hold them for? How do we know when to sell? Okay, all that information we're going to put in the webinar. Right now, set the scene again. So I've given you what the end goal is to try and get these kinds of outcomes. Now, I can't guarantee that NVIDIA will give me that return. Thankfully, since I bought it, if you follow me on Telegram and you follow me on YouTube, you'll know that it's done rather well. It's gone up faster than I thought. And you can see it here in my weekly updates. Yeah, it's gone up a lot faster than I thought it would. Good. That's icing on the cake, a bonus. Had the markets fallen in January and February, it wouldn't have, but it was the same good quality company. So yes, it got some rocket fuel thanks to broader market conditions. Now, before we go into value, growth, income, cash flow, all those factors and how many stocks we should own, how do we know when to get out? Let's just look at the other reason some of you are here, not just to learn how to pick stocks and what the criteria are, but also because, as I said, fund managers destroy your pension. Now, I know I'm preaching probably to the converted here, but forgive me, and I'm only going to show you one slide on this point. That was last year. Quarter of your pension gone in 1 year. That's blue whale. It's a well-known pension. You know how I came across this fund manager? One of my students said to me, oh, my IFAs put me through the employee scheme. Sorry, the employer has put me through the employer pension scheme. into this fund manager. Most people don't realize that when they've got a job, their employer puts them into a pension. They realize that because they see it in their pay packet. They don't realize that pension means it goes to a fund manager. Okay? You probably don't know that. You think probably the tooth fairy gives you your pension. It doesn't. Fund managers get the money, they charge fees, and they get returns like that. I was arguing on Twitter with a IFA who said, that's okay, that's just 1 year. I said, any pension where a fund has been purchased for that pension which loses 27% isn't acceptable. It's in a freaking pension. If you're losing 27%, he said, yeah, but it might not be all his money. Okay, fine. I think there's 0% of your money which should be losing 27% in a year when it's in a pension, especially when it's a fund. The whole point of a fund is lower volatility. So anyway, I'm sorry I'm preaching to the converted on this, and it's just a bee in the bonnet that I have. The other one is obviously IFAs, and Mike, you mentioned it as well. Atur, don't worry. This was this weekend. Okay, look at that, Saturday, February 18th. Okay, it's the Times, the Sunday Times. 1 hour of pension advice cost me £6,000. It's a story about a couple who 20 years ago had a phone call with the IFA. He put them in a pension fund, some funds, and kept getting fees, recurring fees 20 years later. The sum total of those fees, it was murder for them to get that information. This is news to me. I come up with lots of different things I find in the news about how people's pensions are screwed by fund managers and so on. This is a new one about how fees can be tracked for 20 odd years and you're still paying £6,000. Apparently, he didn't tell them, can you stop charging me fees? How was he to know? Poor guy. So there's a lot of people they don't realize this. They're still paying for those fees and they think, oh, it's all right, Alpesh, I see it didn't come up in the statements. Read the Sunday Times article. It doesn't come in the statements, you're still being charged. Nobody's telling them. Why would you if you're the IFA? So just beware. That's another way they destroy it. And then finally, I'm afraid the other reason you're here and you should be here, and you might not know, let's just look at the data again, is I'm afraid you destroy your own pension. And I've got some data on this. And it's not your fault. You're not taught this stuff at school, are you, after all? Look at this data. That's the 10-year annualized returns. Now, I confess it was a good 10 years. This is from JP Morgan. Okay, so we're looking at the data. The S&P 500 generated 16.6% annualized per annum returns. Okay, 2012 to 2021. I grant you it was a particularly good 10 years. The next 10 years probably won't be as good. Just assume they won't be as good for argument's sake. Okay, so we don't have to argue about it. That's how much they generated, 16.6%, which compounded over that period meant, fat cats like me did all right through our SIPs and ISAs and all the rest of it, just because the market tailwinds were good. Right? 2022 wasn't such a great year for the markets, as you all know. Fine. But thank God we had those preceding 10 years. I'll take one bad year out of every 10 good years anyway. But look at the average investor. Look at where you are. Let's just assume you're an average investor. Oh, by the way, that's not a UK one. The UK since that period, okay, you had a good year last year, but sorry, it's not been good for the last 10 years. Okay, the average investor in the UK, I haven't got the figures, it won't be anywhere near as good as that. 8.7%. You were doing half as well as the index, and the index was giving you a whopping 16.6%. I bet you wish you had a time machine now. So what is it? Why is the average investor messing up their pension? There's several reasons. One is, of course, they're giving it to IFAs and fund managers. Now, why are fund managers so dangerous? And I'm not saying you shouldn't use them at all. What I'm saying is, if you're going to use funds is different to fund managers. Please consider exchange traded funds because they're cheaper. Okay, and you've got issuers like iShares and Amundi and all sorts of other. Yeah, there's good big Barclays. There's all big sort of names. So consider those because they're cheaper. Exchange traded funds. I wrote in my Financial Times column 20 years ago that people should be using exchange traded funds, and it's really not controversial compared to active fund managers. That book was one of 18 books which have been published, which I've written and translated into 8 different languages, and I've written in there. So it's been published by Palgrave Macmillan. I mean, they're not rubbish publishers. Most of the time, my publishers are Financial Times. Okay, exchange traded funds. If you're going to do that, so one of the problems is they give it to fund managers who, guess what? Fund management as a retail industry, its job is to market and get as much money under management. Why? Well, because they're paid as a percentage of assets under management. So obviously, how do you maximize profits? You get more assets under management. How do you get more assets under management? You market like crazy. So when you've got a lot of money under management, like $1 trillion of assets under management, you can't just have one fund, the universal value growth income cash flow fund, okay, suitable for most people. No, you're going to have a UK growth, a UK income, a Japanese income, a European growth, an American technology. You're going to split that money into lots of different subcategories, because otherwise, if you only had one fund, even if you bought one stock, you'd end up taking over the company because you've got so much money. So you've got to divide it into subgroups. But if you divide it into subgroups of sub-funds, guess what happens? Your fund manager has a hand tied behind his back. So it's not their fault, poor sods. It's not that they're stupid. Of course, they're not stupid. It's not that they don't know how to pick stocks. That's not the problem. It's that they've been told you can only pick from this narrow gene pool. So they've got a company, they've got companies, maybe 100 companies they can pick from. No wonder they perform poorly, because imagine you had to pick you had to hire somebody to manage your child's inheritance, because that's what investing in a company is. It's managing your pension and your child's inheritance. What's going to happen? You want to see 10,000 CVs probably and narrow those down. If assuming you've got the time, and I'll show you how we narrow down 10,000 stocks into the best 15 to 40 we should have in our portfolio. Fund managers aren't doing that. They're not narrowing it down from 10,000. They're narrowing it down from UK growth companies. Well, there's 100 of those, if that. So they've got a narrow group of CVs. What happens? They naturally perform less well than if they had 10,000 to pick from. Very few funds can pick freely across 10,000 stocks. Where are those 10,000 stocks? I'm talking about all the US listed ones, all the global companies listed in the US, and all the UK ones. And yes, you can have UK and US stocks in your SIP and ISA. And the shame is people don't realize that, okay, that they can. And they say, oh, what about currency risk? And I say, yeah, well, it's worked in your favor for quite a bit, actually, having US dollars, because every time the pound just falls lower in any event. And even if it doesn't, you're holding these for the long term, even though you're changing the stock. So what are you worried about? And dollars are a diversifier for asset classes. Anyway, enough of me on that. There's another problem. This was an article from a newspaper. More than £1 trillion of Muppet money costing savers billions. An eye-watering £1.5 trillion of cash is now stored in savings accounts spread across ISAs, savings and current accounts, according to the Bank of England, an amount roughly equal to the combined value of all UK residential mortgages. That was in 2020. And that's when that's pre-COVID-ish, sort of, before the worst of it and all the rest of it. And that's been there for a while, that money. So it is still you. And I don't blame you not knowing what to do and giving it to fund managers and giving it to IFAs, because who wants to look at this? I love this. That's my job. I love looking at this data. Okay, I love looking at valuations, Goro, and we simplify it across 10,000 companies. I don't look at it for 10,000 companies. I can't do that. I've got a team who will just simplify it, narrow it down. I'll share some of that data with you in a second. But we narrow it down. So let's remove some of those problems, show you the process, and show you the stocks that we've got. Most people, as private investors, pick stocks like a hoarding panic buy. This is how they pick. Oh, I like the sound of that. I read it in a magazine. Name recognition. Now, again, there's research to show this, and I published it in my Financial Times columns, that people buy based on name recognition or bloke at the pub. Because who's going to go through 10,000? They won't know where to start. But actually, you should be having a diligent process of going through those 10,000, which is what we're going to show you. The other thing is they don't know when to let go. Alpesh, I don't know when to sell. So I'm going to solve that problem for you as well. So that we have a simple list. We're going to hold them for 12 months. Then we're going to exit, and everybody's got to reapply to join the portfolio. A bit like a football team. At the end of 12 months, everybody's sacked, or a company. You're all sacked. You got to reapply for your jobs. And you might think, you're evil, evil person, Alpesh. Why can't some stocks just be left in there forever and be shown favoritism just because they once did well 5 years ago? For obvious reasons, couldn't care less. They can reapply for their position. Okay, and we do this because every year the world moves too quickly that somebody gets a free pass forever. This is the process we're going to use. It looks a bit complicated. Don't worry, I've got a simpler version of this in just a second. You know where you hear all these articles and social media and everything else, and you put it all into a little funnel? We're not going to do that. We're going to take all 10,000, not based on name recognition. I then narrow that down into what I call an approved list. You're going to create your own approved list, or based on value, growth, income, cash flow. Okay? Hold for 12 months and repeat. It's going to be 15 to 40 stocks. I'll determine my risk appetite based on my weekly updates. Okay, that's all fine. That's all fine. There'll be some domestic UK stocks for you if you want them. I don't have UK stocks. ETFs if you want them. I don't have them. And US stocks as I do. Okay, so how are we going to do that? How do we filter that? How do we filter 10,000 into the best 15 to 40? Now we've got the makings of a diligent process, and we can see why we should be outperforming fund managers based on that. And we're not going to be doing it on narratives of, oh, AI is really hot, Alpesh. I heard that is really important. Or, oh, there's a war in Ukraine. Maybe we should go into fighter jet companies like Lockheed Martin. That's not a diligent process. That's just guesswork. No, if some of the companies show great figures, oh, and it just so happens, that makes sense why you've got Microsoft and NVIDIA. I heard it's going to do well because of AI. Well, fine. So what? The narrative fits the data rather than the data trying to fit the narrative. Okay. Now, what's also underlying all of this? Now, I've written, as I said, 18 odd books, and in my weekly Financial Times columns, I would refer to research like this and research from Nobel Prize winners like Daniel Kahneman as well, and discuss with my audience, the readers, what works in investing. And guess what? It's been researched. Of course, it's been researched. It's a multi-trillion-dollar industry. You don't think they've had the best brains looking into it for decades and decades? This just happens to be one piece of literature that I've referred to it in the past. That's what led me to take my approach, which was, well, why don't we just tick every box? Why try and guess, oh, it's a value stock. Oh, it's an income stock. Oh, I see there's some, Anila, thank you. We'll discuss that. Mike will discuss the expat issue, because you're an expat, you're in Spain, so there might be tax issues there. Roy said, don't you charge 2 and 20 hedge funds, not retail, as well. Roy, we charge 2 and 20 to institutions, big, fat, rich institutions. So I can badmouth people, not to retail. We don't offer to retail, to big, fat, rich institutions. So if you want to defend institutions who pay our fees, it's entirely up to you. But my institutional investors have no issues. Okay, if you want to defend retail fund managers who are destroying your pension, that's entirely up to you. Okay, these are the factors we're going to look at. Now, why are these factors? Well, first of all, I don't want to try and gamble on the next news item and try and say, oh, I'm going to outsmart everybody else. I think I know which way the future is going. It makes for good stories. It makes for good journalism. It makes for good, when I'm doing newspaper reviews on the BBC, makes for good TV. But actually, the fact of the matter is we don't know whether it's going to be undervalued stocks or high growth stocks or good income stocks. So why don't we tick all those boxes? We've got 10,000 to pick from in any event. Now, we happen to know, for instance, that the valuation of a company does impact its future share price performance, but it's not the only factor. We know it's not the only factor because you can have overvalued companies doing incredibly well. And undervalued companies might be undervalued because they're rubbish and they never do well at all. So we know valuation is important, but it's not the only factor. And we know there's a multitude of ways of valuing companies, like price earnings ratios, price earnings growth, price to book, price to sales, discount cash flow. My God, what are we going to do? No wonder private investors give it to useless fund managers who keep underperforming. By the way, Eugene Fama got the Nobel Prize in Economics 2 years ago for proving that retail fund managers, Roy, consistently underperform just an index tracker. Okay, that's why I badmouth retail fund managers. They're sort of the poor cousins to the hedge funds. They're the people who couldn't get a job as a hedge fund manager, so they went into retail fund management, and they underperform. So he got the Nobel Prize for showing that over a long period of time. I had the IFA still complaining that, yeah, but the Nobel Committee got it wrong, was basically his view. Can you believe it? That's how much people hold on to their profession. So valuation, we know, is important. So we're going to look at that, but we know we don't need to look at all the factors, because actually a lot of that just duplicates what when a company is cheap, its share price relative to profitability or relative to discount cash flow. Okay, we know growth of a company is important, but the research and the data from academia suggest it's not as important a valuation. Okay, so we know it's important. So we know we want to tick the growth box. You see, people will try to send you a fund. The fund manager will try and sell you a fund which says, UK value stocks or Japanese growth companies. Well, wait a minute. Why does it have to be a value company or a growth company? Why do we have to try and guess on CNBC whether today's the week or the month or the year where growth companies are going to do well or value companies are going to do well? Why can't we have value growth? By the way, I picked this approach completely independently of Mr. Warren Buffett, who has, and you can see his videos, a similar approach, which is actually wants to tick all the boxes. He wants the companies to be undervalued and good growth. So we'll look at sales growth, earnings growth, cash flow growth. We also know that on the whole, companies with good dividends or dividend paying companies tend to perform better than ones who don't. However, there are many exceptions. So we know it's one factor, but not the only factor. And what confuses people who are not used to just basically decision making, what confuses them oftentimes is this, that they say, oh, but I found an exception, therefore everything, so it must be completely irrelevant. There's an exception. There's a company which doesn't pay dividends, which did really well. Therefore, dividends must be irrelevant to future share price. There's a company which was overvalued and went up. Therefore, valuation must be irrelevant. There's a company with low growth which went up. Therefore, growth must be irrelevant. There's an exception. Therefore, there is no way to pick stocks except throwing darts at a dartboard, which is perfectly fine. If that's what you believe, you should get a new dartboard. But we know we've got to tick that box. And by the way, I'd say in terms of weighting, 40% weight to valuation, 20% to growth, and about 10% to income, and then the rest to these other factors, such as momentum. We know trends and momentum and direction of flow, and I showed you NVIDIA earlier. Trends tend to persist. They're not just a coin toss. There's something about it. If you want to look at the research on that, there's research from Daniel Kahneman on that, for instance, again, Nobel Prize winner, David Harding, Sir David Harding on that, founder of Winton Capital. Okay. And then we'll look at some of the statistics, and I'll show you this as well. And I'll give you the names which have come out as a result of this. You can see when somebody's looking at all this, they bang their head on the desk and say, forget it. I don't want to do any of this as well. Okay. So how do we get the data? How do we simplify all of this, right? So it's not so difficult, because we know it's important, because it's our children's inheritance and our pensions. So we know we've got to do it, but we don't want to be sitting there banging our head on the table. That's why I've drawn that person there. Now, I don't mind doing it because I love it. I love looking at all that data. I'm a geek. Okay, I love it. Within our company, I hardly do any of the private equity stuff. My partners do that, even though the private equity stuff where we invest in healthcare and in clean energy is going to save the world. They love it. They're saving the world. I'm not. I'm looking at this. I'm not saving anybody's world, right? But I love it. What can I say? So what is it? What are the breakdowns now? This is what we're going to do. So let's look into that. The strategy is we need to tick the valuation, growth, income, cash flow, outperformance, and volatility box as well, by the way. I want volatility to be below 20%. Outperformance means this. I want what's called a Sortino. Now, in the hedge fund industry, when we're raising capital, and I hate raising capital, it's like going out with a begging bowl to pension funds like Aegon, AXA, thank you, they've, and family offices, basically institutions, and asking for capital. And I hate it. Well, the one thing we're asked is actually not performance. Is what people think. You're asked your performance. The first thing you're asked is your Sortino. And retail fund managers have no idea what that is. I used to sit on the investment committee at Chatham House, which is the Royal Institute of International Affairs. And if you ever asked a retail fund manager, sort of the long-only fund managers, sit across the desk from Casino, whatever, what's your fund Sortino? They'd just look at you blank. It's like they didn't even go to fund management school. What it is this. It is the measure of the average return versus the volatility or risk of missing it. And you want that to be as high as possible. It's like a cricketer. If their average is 50 and they get 50 every match, that's a lot better than somebody whose average is 50, but some matches they get 100 and some they get a duck. They're not as reliable or consistent. You want that Sortino to be high, and you're not just looking at the last match where the guy got 100, but actually normally his average is 40. Okay, so that's what it is, and that's what I mean by outperformance. The other factor is something called alpha, which is outperformance of the indices. So we want to look at that for the individual stocks and tick that box as well. Right now, that's going to give me a list. That's going to give us a list where we're going to go from. I'll just show you this. Right, so we shove all that in, and that's going to give us a list where you're going to go from 10,000 stocks. Still, we're getting there, right? It's my pension and child's future, and I don't want a fat cat IFA charging me fees for ever doing it, so I need to do it myself, right? We're going to go like that, right? And that needs to be, then it's going to give us some which have got greens across all of those. Value, growth, income, cash flow, outperformance, and volatility. If they've got greens across all of those, then we're starting to get a narrow list, but we still need some tiebreakers or tactics. Call it tactics, call it tiebreakers with those remaining stocks. It's like having interviews. You've shortlisted the candidates. You don't interview every candidate for a job, do you? You narrow it down to who you're going to call in for an interview based on, I don't know, it might be grades, it might be university they went to, could be any of those factors. So how do we tie break? You've got two identical companies, or you've got 80 companies, you want to get it down to 40. And like in an interview, in the end, sometimes it goes to, well, that person spoke a bit better. It's not really relevant to performance, but we'll give it to that one. Or that one was more humorous, or they didn't suck the energy out of the room. It's not one of the official criteria, but it's a tiebreaker. That's what tactics are. They're tiebreakers. Now, this is, again, where people get it wrong. Most people pick stocks based on tiebreakers, not on strategy. Or if they pick a strategy, they only pick one of these. They say, oh, it's undervalued, so I'll pick it. Or they say, oh, no, I'll just pick it on a tactic. Its geography's right, okay? Volatility or sector. Oh, it's a tech company, so I'll pick it. That's not enough due diligence, for God's sake. It's your child's future you're talking about. That's not enough. So how do we break this down? So as I showed you earlier, what we do is and I suggest you do the same, you've got to have your breakdown. Now, I create my proprietary ones, but you've got value, growth, income, cash flow. For cash flow, I've used cash return on capital invested. I'll tell you what that is in a second. This I just put into one score out of value, growth, income, but you'd obviously break that down. But I just created a scoring mechanism, proprietary scoring mechanism to do that. And Sortino. Now, this data, you can get data that allows you to do this. Yahoo Finance will give it to you for free, okay, and break all this down. But what I'm saying to you, the most important thing is if you start picking stocks yourself, then you better look at valuation, you better look at growth, okay, you better look at income, you better look at cash flow, otherwise you're missing important things. And I like to look at momentum. I like to make sure that over the last 6 months that actually the price has gone up. Okay, that the price has gone up. Why? Well, that's the most recent past, and if it's done well over the last 6 months, then hopefully, I'm not going into turnaround situation. I'm not bottom fishing. Why? Well, that's my choice. I just don't like turnaround situations. Too stressful. Companies be doing really rubbish, Alpesh. Shall I buy into it? Well, yeah, if you like a stressful life. I like the kind of companies which are doing well. They're going to make my life easier. I'm going to feel happier for it. Okay. So let's break down some of the numbers and break this down even more. The important factors are value, growth, income, cash flow, Sortino, alpha, and then tiebreaker tactics, which we'll go into. Monitor it infrequently. Those people who, I've got some students who will monitor it like daily, and they're going nuts because we're going to hold it for 12 months. These are going to be the numbers. And by infrequently, I mean maybe once a week. Okay. And this is what you're going to monitor for in your portfolio. You're going to pick for 12-month holdings. Why 12 months, Alpesh? Well, if you're investing, then 1 month is probably too short and 10 years is too long. Too much happens. So we're picking 12 months. I've actually got some academic research behind that and some data behind it, but it doesn't matter. Oh, by the way, this book, you can download a free copy at the end of the webinar. I'll give you the link so you can download a free copy of my book, Investing Unplugged. So you can see sort of the academic research behind it and the Nobel Prize winners whose shoulders I stood on to come up with all of this. So 12 months. Now, 15 to 40 stocks, 15 to 40 stocks, okay? Not less than 15, not more than 40. And I'll show you why, roughly, that works well. Now, you might say, no, Alpesh, I'm going to trip you up. What if all 15, I only pick 15, and they're all technology companies? Well, then I'd say you're pretty stupid, aren't you? You probably want a wide spread of not just all being in the same sector. Actually, when the markets fall, again, there's research to show this, when the markets fall, everything's correlated. Whether it's Walmart and Microsoft, two different sectors, they're all correlated. Correlations increase to the downside. So this notion that, they're in different sectors, yeah, that worked well in the 1980s when you learnt it. But today, that notion they're in different sectors, so I must have a diversified portfolio, it's not true. Okay? Walmart and Microsoft are correlated to each other to a higher extent than most people realize, and when the markets fall, to an extraordinarily high extent, right? And that's partly as a function of the rise of exchange traded funds. Now, 12 months, 15 to 40 stocks, 25. That relates to, this is my hard stop loss. It's my default stop loss. if any stock drops 25% from the highest it's been since I bought it, so let's say I bought it at 100 and it went to 200, so it made 100% gain. For argument's sake, keep the numbers simple for my mental maths. Let's say it then went from 100% gain to 75% gain, so it dropped 25% from the highest it's been since I bought it, then I'd exit. That's a default. You might tweak that, and I'll show you this. There's a little flow chart I've got where you might tweak it. You might say, well, no, Alpesh, I'll sell half of it if it drops 10%, another half if it drops 25%. You can tweak and play around with it based on your risk appetite. I don't want to argue the toss over it, but the reason there is some kind of stop is so you know you're not just holding it either forever until it drops lots. Now, that protects me. Let's say I pick, for argument's sake, and this has never happened, a bunch of stocks. It didn't even happen in the financial crisis, by the way. A bunch of stocks, and from the day I bought them, they all dropped 25%. So they didn't even go up and give me a buffer. Not 25% from the high since I bought them, but actually, the day I bought them, they all dropped 25% the next day, for argument's sake. My overall portfolio would be down 25%. That's a lot. That's never happened. It's highly, even in the financial crisis, okay? What more usually would happen is some would have gone up and benefited from the market and so on and so forth. And some will hit the 25 on a really bad year. Like last year was pretty bad. The financial crisis was pretty bad. And there were negative years. And even then you had stocks which didn't hit the 25% because guess what? The market tends to go up first, gives you a bit of a buffer before it drops. So you've got some protection or you get risk averse, you sort of do your weekly update, you look at the S&P and you look at it and think, you know what, I think I want to turn to cash. That's what happened last year, 80% in cash, didn't wait for everything to hit the stop. Got it? You look at that, and how do you make that decision then, Alpesh? That seems a bit complicated. Well, actually, it's not a bit complicated at all. People often ask me, what should I do, Alpesh? So I create a little flow chart. So feel free to take a picture of that. I just want to make sure that moves across. The images seem to be moving a little bit more slowly than the images are moving more slowly than the slides are moving rather more slowly. Here we go. Now, so what happens there, and I think I know what's happened. Whoops. Let me just share my screen. It's the entire screen I should have been sharing all this time. I think I've not shown you the whole shebang, and Alex pointed it out correctly. There we go. It should have been showing you the entire screen. So what happens there is I want to show you how we instead, where's it gone? I'm going to show you the Excel spreadsheet. Here it is. Here's the Excel spreadsheet. That part, and what I didn't show you earlier on, and Alex pointed it out, was this. This is what I'm talking about with my Excel spreadsheet. Okay, that's 10,000 stocks. I think that's what you didn't see earlier, Alex. Thank you for pointing that out. See? And we want greens right across the board. Whoops. Better not move anything. Want greens right across the board. That was the bit that I think earlier on you didn't see. Now, what I'm talking about here is this part. So I created this flowchart. I find flowcharts a lot easier for thinking because it means I don't have to keep reminding myself what was the process again. It just saves loads of time. So people ask me, what should I do with my cash? And I say, well, if you're risk averse based on S&P 500, my weekly update, then I'll wait a month before I buy any stocks. Or I might average in over 3 months. So if I've got £10,000 of Microsoft to buy, for argument's sake, I'll buy 3,300 this month, 3,300 next month, 3,300 the month after. When I'm ready, or I become risk loving as I am this year, then it'll be off that approved filtered list, volatility under 20%, maybe still the S&P 500, the bigger ones, but it could be the smaller ones based on the quality of the companies. But it's still got to be all greens. It's got to be a 7, 8, or 9 there. It's got to be green, green, green by cash flow, green by momentum, green by Sortino, green by alpha. Why? Because that ticks the value, growth, income, cash flow box. Anything less than that, and I'm not doing sufficient due diligence, and I will end up waking up at 3 in the morning going, oh my God, that company fell, and I missed so much checking that I should have done on it. So 15, 25, we've done the stop loss. 40, as I said, is the hurdle rate. Can it reasonably do that? And I'll show you some of the stocks we've got in the portfolio and how I determine, like I showed you with NVIDIA earlier on, can it reasonably, not guaranteed, nothing guaranteed, give me 40. And in actual fact, if it gives me 20, I'm over the moon anyway. So 40, one strategy, many tactics. The strategy is value, growth, income, cash flow. And I said 20 to 40 max, well, 15 to 40 max investments. Why? Well, this is essentially it. why you shouldn't have more than 40. Now, how much does your average fund manager have? He has 100 stocks. Well, he's got to get kickbacks from brokers, doesn't he? And he's got to spread that money along as well. It makes no sense for a fund manager having, if he's got 100 stocks, that means he's got some stocks where he's put less than 1% of his money, because he'll put more than 1% in others. If he's put less than 1% of the capital in a particular company, how much confidence does he have in that company doing well? Given that, what he's saying is, well, if that company, let's say, did double up, it'd add less than 1% to his portfolio. So maybe he's just afraid that it's not going to do well at all. And if that's the basis on which he's picking stocks, ones which won't necessarily do that well, well, no wonder they're underperforming in any event. We're going to pick 15 to 40. Okay. Now, why? Well, that should remove most company-specific risk, unless you happen to pick every single one of those 15 in the same identical sector and they're all just the same company, basically. But most of the time, for most people, that's what will happen. Now, market risk you can't remove. Market risk you can't remove by increasing the number of stocks. The only way to remove market risk is not to be in the market, to be in a bank account, for instance, right? So that's why we're going to do that. Now, these are some of the ones that I hold at the moment. It's been a good start here. This has been since January the 1st, okay? Just because I hold it today doesn't mean I would buy it today. So don't go out and think, oh, I'm going to go buy these, okay? No, and these are just some of them that are in the SIP and my son's ISA. Now, I'm not going to go talk to you about leveraged exchange traded funds. That's a whole different thing, and it's too high risk for this audience. So I'm not going to even talk about those. That's something separate. Okay. Now, Tesla was not based on value, growth, income, cash flow. It was what I call a special situation. Occasionally, there'll be special situation stocks that have got nothing to do with my criteria, and I'll share it on my Telegram with my students, and I'll say, right, I've picked this. This is what I think will happen. It's high risk. Special situations are always implicitly high risk. It just so happens since the start of this year, it's gone up 41%. It had nothing to do with Elon Musk, electronic vehicles, or any of that. It was a special situation based on other factors, fundamental factors and chart factors, and most importantly, the monthly direction of the chart. Nvidia, Brunswick, Criteo. You might say, who the hell are some of these? Okay, Warner Brothers, Apple, Microsoft, Globe Payments. These are just some of them. My worst performer so far this year is Cambian Networks, and I think it's down about -6%. But hey, it's February. I'm waiting till the end of the year. Equally, this means that I might take the profits on Tesla and say, well, I'm not going to wait for it to drop 25% from the 41%. We'll do a weekly update and say, do you know what? I think it's good. It's done better than I thought it would. I'll take it. What does it look like? That's what's in there at the moment. Doesn't mean I'd buy it today, as I've said there. 12 months, 15 to 40 stocks, 25% from the peak. Okay. These are just some. This is not my entire portfolio. These are just some of them. What does this is just 6 weeks. Oh, too early to judge after what, six weeks, Alpesh. You're right. What does it look when there's a tailwind? Okay, not a headwind, a tailwind. I already told you if there's a headwind, if the market crashes, let's say I've got 15 stocks. I only picked 15 and I put my money equally into each, and it fell 25%. One of the stocks fell 25% from the peak since I bought it. Well, that would mean 1/15 of my money lost 25%, which means I lost 1.8% of my portfolio. 1.8% of my portfolio is what I'm risking on any individual stock. If I take just 15 stocks, if I take 40 and one of them drops 25%, I'm risking what, 0.5%? You can do the maths. So that tells you what the worst case scenario is. When there's a total headwind and financial crisis, or last year was pretty rough, what happens in a good 12 months? Not typical, because it's not in my gift to give great 12-month period. This is what happens. Now, I want to show you this for a couple of reasons so you understand how stocks and investment works. You get a 54% return. You're saving that for the years in which you get a 0% return, of which there'll be occasionally over 10 years. There might, just look at the stock market. There are 1 or 2 years where you get negative returns. US, I'm talking about. UK, you get it more frequently. Italy, my God, you get it more often than not, right? We're not going to look at Italy, obviously. So typical stocks, filtered list in a good year, good 12-month period. So Alpesh, why did you, so these are the questions. Why did you not hold Crocs going forward? Why do you only hold it for 12 months? Actually, our 12-month rule was proven right, because After the 12 months were up, the stock, like a ripened fruit, you buy it when it's not ripe. It had got ripe. It had produced that 208% return. It had got overvalued by the time we sold it. And then it crashed and burned. Okay. We'd got out of it by then because we hold for 12 months. So that's a reason why we don't hold just because it did well. Most people will make the mistake of thinking, oh, if something's in my portfolio, then I should hold on to it because because the rest of the market looks at my portfolio and therefore it must go up in the next 12 months. No, it doesn't. Just because it's in your portfolio has no correlation to how it'll perform going forward. Just because it did well in the past 12 months has next to zero correlation to how it will perform. So those are the two mistakes people make. Oh, I did really well in Crocs. I'm going to keep on. I've become a fan. You're not marrying it, as Warren Buffett often says. You marry a partner. You don't marry a stock. Okay, so we got rid of it. There's another question. Hey, Alpesh, if you're that clever, how come you just didn't buy Crocs and nothing else? Because I'm not that clever. Actually, I did a TEDx talk called "If You're So Clever, Why Aren't You Rich?" which was to look at the correlation between intelligence and money and why people so often mess it up. Why didn't we just buy Crocs? We didn't just buy Crocs because I did not know that would happen. I thought there was a reasonable expectation if there's a tailwind that we should get hopefully a 40% return, 20% if not, okay. In fact, we got a 208% return. If I knew that was going to happen, I would have only bought one stock. Even Warren Buffett doesn't just own one stock. He has a portfolio. I'll show you what's in his portfolio in a second. He has a portfolio of more than one stock, okay. Generac, same issue. Costamare, don't even know what the hell Costamare do. And that's another point I want to make by showing you this chart. We look at the data of the companies. Warren Buffett once bought into a Chinese, I think it was a bank, and they said, why did you not go over and meet the directors? And he said, what are they going to tell me that I don't already know? They're going to tell me how wonderful the company is. Why should I waste the jet fuel? My point is, I don't meet the directors. What they're going to ever tell me? Oh, it's a wonderful company. I don't want to hear their stories and their narrative. I want to see the numbers. Now, short of their numbers being fraudulent, which hopefully there won't be in the market, and if you think they are, then you shouldn't be investing anyway in anything. Short of them being fraudulent, I want to see their numbers. Then if they make ugly shoes like Crocs or they make power backup systems like Generac, I don't care. Okay? Because all companies are a mechanism, whatever they do, for turning capital into profits. Doesn't matter whether they're selling sweets or AI software. It's just the stories are better if it's AI software. Okay? Who's going to write a story about Crocs? No one, but that gave 208%. Who's going to write a story about Microsoft? Bloody everybody, funnily enough. Those ugly bloody shoes. I asked my wife, I said, you know, you're not going to believe this. Rian's junior ISA has got a stock which has gone up 208%. It's called Crocs. She goes, yeah, they're all over Instagram. They're just always using these influencers, these influencers to constantly plug it. I said, all right, that makes sense. But that narrative wasn't relevant to me. What was relevant was the data. There'll always be some narrative that you miss, and that's the way to look at it, okay? Anila's asked, but some companies are good long-term holdings if it's a good company. And Anila, you're right, but what you do is it's got to reapply for its position, and you might readmit it. Let's take, for argument's sake, just agree with me on this for a moment. Let's assume you're talking about Amazon. Just assume it, okay? You know, you might say, oh, no, that's a rubbish company, and last year it was blah, blah, blah. Okay, just assume. Okay, so at the end of 12 months, you look at it, you go, actually, that's still a good company. So it stays in your portfolio. Next year it goes, right, actually, that's still a good company. So it stays in your portfolio. So you're right, Anila, but you don't give it a pass ahead of time, because there'll come a time when what you think's a good company and you've given it a 10-year tenure. You're in medicine, Anila, if I remember correctly. You know, tenured professors. You're just giving them you've got to keep re-interviewing them. It's your portfolio. So let's just look at some of the numbers and the outcomes. Why are we doing this? What's the outcome? Let's assume you plan to invest over 10 years. And this is what I show. I give lectures at schools and I sort of encourage kids to invest as well as their parents. And I've got a TEDx talk coming up at Haberdashers, actually, and this will probably come up. Let's say you make 20% per annum. Now, remember, the S&P delivered 16.6. You might say, oh, it's totally unrealistic, Alpesh. Well, in a headwind year like last year, you're right, but there won't be many of those. So just run with me for the numbers for a second. You can always dial them down if you don't believe you can get those returns. Nothing extravagant, nothing pessimistic. Let's say you've got 100K in your 401k, your SIP or ISA, for argument's sake, and you plan to add 1,500 each month. So you're in what I would call, I'm going to call you rich for argument. You might say, are you kidding me? 100K is peanuts nowadays. Yeah, I know, but I'm going to call you rich because the next portfolio I've got is for sort of poor or mass market, okay? You'll have $1 million by the end of 10 years. Whoops. My job for my family is to convert every 100K into $1 million. It's really simple to put it in those terms. I mean, I like simplicity. That's my job. Hopefully in less than 10 years, given that, as they point out to me, well, okay, hot shot, Mr. Big Head, you've written all these books and stuff. It better happen sooner than that. Okay, fine. How's that work? This is how it works. And this is how I want it to work for you. Value, growth, income, cash flow. You're ticking all those boxes, and you're looking for those kinds of companies. Surely year 1, year 2, and so on. Year 10, okay, there's your total contributions. That's that line. That's your future value. Now, why don't people bother doing this? Well, first of all, they don't know how to go about picking those stocks, ticking those boxes. Secondly, and by the way, this would all be tax-free because it'd be in an ISA or a SIP, okay? Secondly, in the first few years, people say, oh, yeah, you should compound invest. What people don't realize, first, 3 years, you're putting a lot of money in, but it's barely moved your portfolio pretty similar to the capital you put in. It only really makes sense over here, right? Where by year 8, you're so grateful you started 8 years earlier, because in a year, you're making about 100K a year. Hang on, you're making 100K a year in 8 years. You're making the same as your initial amount in 8 years' time in just profits, gains. Yeah. Not me, I didn't invent this. It's just how the data works. And you might tone it down. You say, no, I'm going to do half of that. Okay, halve everything. Fine, right? Well, let's say you've only got 10K to start with. I know I've got some students on here. I know I've got some people who are professionals. Cash, the biggest group I have are cash-rich, time-poor professionals and business people. They're time-poor, cash-rich. Those are the two groups. Professionals, doctors, dentists are really popular. Lawyers, actually lawyers not so much, accountants. Ravi, accountant, okay? And then on the flip side, you've got students and they're starting out, but they're going to get more money later. So I said to people, even if you're starting out with 10K, it's fine. Let's say you plan to add 6K a year, then this is what your returns would look like. Again, now this is closer to my son. When he was born, we maxed out his junior ISA allowance each year, and he's about to turn 5 on the 27th of February. So that's where he is. Now, if you look at that, he's actually, thanks to 2021 and 20, if you look back to when he was born in the stock market, you can see the first 3 years were rather good for the market. Last year wasn't so good. So he's a bit above that, but that doesn't matter. Let's just assume he stays there, because there'll be future where he might just go back down to that, right? Actually, what I'm doing this for is by the time he's getting ready for university in another, what is that, for 13 years, the little bugger should be getting about 100 grand a year in his ISA, just automatically. That's the plan, that's the figures, and that's what happens, right? That's why we're doing it. And it says, we have annual appraisal, so yes, you're correct, I guess, with 12 months. Yeah, and you can just reapply the same companies if you wish, but you shouldn't assume that just because it was in your portfolio last year and it did well, that it should automatically stay in. You should reevaluate for all 10,000 companies. Okay, imagine you're the boss of the company, no longer the employee, right? Those are some of my, I've spoken about, these are paying past and present clients who've paid for me to explain this to their audiences. Okay, and Barclays did a book launch where I explained all of this as well. I've written about it in many books. One of the things that I want to show you, and it's done well for me anyway, and I've written about it in the Financial Times as well. None of this is controversial. Somebody saying to you, you should pick undervalued companies with high growth, good dividend yields. That's not going to sort of scare the cats, is it? It's going to be like, all right, okay, that makes sense. None of it's controversial. It's not like some secret formula, but I want to show you something else. 12 months reevaluate, right? That's the when to sell part. This is the other thing. This is why 10% to be kicked into this is taken from a typical fund, retail fund. This is why I want people to be educated, to be able to do more of it themselves. Okay, if you feel confident enough to do it yourself. Investment, say you did £10,000. This is from them. This is not me. This is a typical fund. It was called 91. It's a fund provider. And one of my students came to me and said, oh, I've got this fund. I said, send us the documents. Well, actually, no, I said, send us the name. We'll pull down the documents from them and check it. And this is what was happening. If you cash in after 5 years, recommended hold period. Now, why do fund managers, retail fund managers say 5 years recommended holding period? Because they're guaranteed 5 years worth of income to send little Georgie and little Susie to private school. Well, that's me being cynical. Oh, no, Alpesh, it's 5 years. Because, you know, you should give the long-term view on the markets. Yeah, no, it's 5 years because they know in any rolling 5 years, they'll probably have delivered above 0%. That's not the problem. The problem is, what about the opportunity cost of how much money you've missed? Nobody psychologically cares about how much money they could have earned. They care more about what they actually lost. So all these fund managers try and do is make sure you don't actually lose. So they ask for 5 years' time, but they don't tell you this is what you could have made ever. You lose £1,000 in fees. Every 5 years, you are losing 10% of your capital just in fees. That's their numbers, not mine. And you might say, no, that's not true, Alpesh. I looked, 0.5% is the fees. Really? Really? Pull down the document. It's usually on page 38, buried. Okay? If you don't believe me, just Google Sunday Times fund manager hidden fees. You'll find it there as well. Okay? Yeah, I've got a problem with retail fund managers. And why have I got a problem with retail fund managers? Well, because with my big mouth, the Financial Times asked, well, can you outperform them then? You've got a big mouth, bad-mouthing them, big boy. So in 2004, they ran a competition over 12 months. And Neil Woodford at that time, and this is what, you know, I mean, don't need me to badmouth Neil. Or maybe you want to defend Neil. If any of you want to defend Neil, there he is. Just a little bit better than Jasper the cat. I know I'm picking on a straw man. Why not pick on the others? I won that competition with my big mouth. I said to the FT, when I win it, you put me on the front page of your business section and say, I bloody well won it. That's the deal. And that worked out nicely for me. Well, it didn't actually. It worked out terribly for me because Neil went on to get £9.2 billion in assets under management. I didn't. The year later, I launched my hedge fund, my private equity fund. We didn't raise anywhere near that. I didn't have the square jaw. Apparently, you need a really good square jaw like Neil. You need to sort of look at how fat I look. Apparently, it's that. It's all to do with just being fat, apparently. Anyway, not bitter. Underperformance is rife amongst active fund managers. Not me saying it. It's not me saying it. Okay, underperformance is rife. Okay, amongst active fund managers. That's from the Financial Times in 2011. It's not changed. It's not changed anytime since. And well, there you go. That's an investigation into St. James's Place by the Sunday Times, and that was done in 2020. I'm not just having a go at them. So once we've got, what are the other tiebreakers? So and I'm then going to show you some more of this. More of the individual stocks and so on. What are the tiebreakers I might use? So let's say I've got 80 stocks. How do I tie break that down? Well, one of the ways in which I might tie break it down, I'm going to break it down for you now, is I'm going to show you some of the UK companies because I've not done that too much here. Okay, let's take Jupiter. Oh, but I thought you hate fund managers. Yeah, not if the stock price goes up. Not if the stock price goes up. Okay, RWS Holdings, tiebreaker will be discount cash flow. That's just a measure of discount cash flow. Okay, undervalued. Now, it was already ticked the box on value, growth, income. Why do I want undervalued 47%? Because again, it shows, have I got a reasonable perspective, reasonable prospect of making 40%? Well, actually, according to discount cash flow, I should make 100%. Nothing's ever guaranteed in the markets, as you and I know. So if I, again, take the Warren Buffett philosophy, although it's not because of him I did this, it's just that I then heard that he does the same, which is he doesn't just look for small margins, he looks for absolute no-brainer massive margins. That's 100% margin, because if it goes from £3.76 to £7.14, okay, I don't own this because I don't own UK stocks, as I've already told you. So just full disclosure, I don't own any of these Spectra, but they meet our criteria. Just so you know, I can't buy everything, and I don't buy UK at the moment. Spectra Systems, okay, 66% undervalued. UP Global Sourcing, less so, 32%. But you'd almost double your money, so more than 40% but that's a tiebreaker, just to be absolutely clear. Another tiebreaker, what do the gurus hold? That's a bad word. These are all billionaires and these are their portfolios. Take a picture. Just because they own it doesn't mean I'll go and buy it. Okay, it just so happens when Warren Buffett has Apple, I own Apple. Okay, it just so happens he has Chevron. I did have Chevron. I don't anymore. We got out of it. He has Occidental. I don't anymore. We got out of it last year. Because remember, I bought some energy stocks last year. If you follow my updates, you'd know that, right? These are all billionaires. Bill Ackman, you'll know these are his. It doesn't mean I buy it just because, yes, they're tiebreakers. Okay, I might look at the hedge fund ownership reports if I need a tiebreaker and see, this is historic, I don't own AbbVie, this is historic. If there's a stock in there which I see hedge funds buying and it's in our approved filtered list, and I think all other things being equal, I'm going to go with the ones where I'm riding the coattails of the aggregate, some of the world's biggest funds. Or filtered and deeply undervalued, as I just showed you. This is a current one, I don't own it, just so you know, but it meets all our criteria: value, growth, income, cash flow. 57% undervalued. So is there a reasonable prospect I could get my 40% return? Yes, given that it meets my value, growth, income, cash flow, and it's deeply undervalued based on what's called discount cash flow. Wait a minute, Alpesh. Is that guaranteed? No, of course it's not. I wish it was. If it was guaranteed, I would sell my mother-in-law on eBay, even use that money to buy. I would put everything, I'd sell the clothes off my back and put the money into it if it was guaranteed that I'm going to double my money. But it's not guaranteed, which is why I don't know, mortgage my home and live on the street and put all that in for a year. Okay, that's why, because it's not guaranteed. The other thing I'll do as a sort of tiebreaker is if I find stocks with low volatility, there's a company called Wolfram Alpha, they give this data for free. What are the likely statistical distributions of stock? This happened to be McKesson last year, not now. Don't do it now. This is last year, okay? And it had just a really good distribution of returns. In other words, over 250 days, it was not likely to drop, just statistically. Over 20 days, it might drop a little bit. So I would, in that case, do 2 times leverage. I'm not recommending it for you. It's a different conversation. It's high risk. But I'd either use CFDs or exchange-traded funds. With this, there wasn't an exchange-traded fund, which was 2 times leverage, so I did the CFDs, and this was the company. Okay, it just so happened with that low volatility, and if you followed me on Telegram, you'd know it. It was probably the best one last year, the best of our picks last year, and you can see that was up about 50%. So we didn't quite do 100% return, but it was sort of shy of it. That made up for some of the ones which fell last year. Didn't completely make up, but you know, that's what happens even in a bad year. You get a bit. Others, well, we'll look at analysts. Another tactic as a tiebreaker, analysts, return potential. What do the analysts say on average? So we'll look at where the share price is, and we'll say as a tiebreaker, actually what will happen is Shireen or Simpy from my team will create this whole list up from the approved filtered list each month. They will narrow it down into a table of monthly further filtered stocks like this, which meet those criteria as a tiebreaker. So really reduce the number of stocks down from 10,000 all the way down to about 50, okay? Including, that's where the share price is. That's what the analysts say it can achieve. So will that reasonably give me my 40%? Yes. Okay, then that's in the mix. That's then in the mix. Okay, that's a critical fact. I don't own Alliance Resource Partners because I can't buy everything. The other factor, it's one of the most important that I use, and I've stolen it. Okay. Anila said I can recommend an anesthetician for square jaw. I need more than a square jaw. I think I also need double chin. Maybe you can removed. Is this cash return on capital invested? Now, this is a slide which I stole from Goldman Sachs Asset Management. As a hedge fund manager, you get invited to all these dinners and lunches. And there was a lunch by Jim O'Neill, now Lord O'Neill, who was then chairman of Goldman Sachs Wealth Management before Sheila Patel took over. And Jim, I was sitting next to Jim at the lunch. I don't know why they put me next to him, because there are far bigger managers than me out there. Anyway, they put me next to Jim. There were about 12 of us, and they gave us a presentation. And this was one of the slides. And it blew me away. This is a formula invented by Deutsche Bank Wealth Management. It's now used by Goldman Sachs Wealth Management for their richest clients. So if you want them to do this for you, just give them 50 million in a private account and they'll do it for you. But here I'm just sharing the formula with you for free. Okay. They use this formula, and what they discovered is that it's called cash return on capital invested. And what they discovered is companies with a high cash return on the capital they've invested in the business generate 30% per annum returns if they're in the top quartile. The top 25% of companies by Croakey, okay, generate 30% per annum. Not every company in that quartile and not every year. Look at that. In the financial crisis, nobody got that. They got negative returns. In the financial, got negative, right? So you understand, not every company and not every year, but on average over the long term. Long term, well, that was up to the point when I got the data, right? So over the long term. So we look at Croakey. We put that into our database. We put that into our database and we want to see which companies are in the top quartile. But that's not the only factor, remember. Not the only factor. It's got to go green across all of these that we look at. Okay, I'm not going to click on that Feb approved filtered, which shows all the greens because that's only for clients. I've shown you what I own and they meet that. And I've given you a bunch of other names. I can't give you every single name. I show you in the last 10 minutes something which was spun out from the fund, which you've seen me dissing, criticizing retail fund managers. We've spun a piece of technology out of the fund, which we think will impact enough of the multi-trillion-dollar retail fund management industry as to make us, if we get venture capital into that and then eventually IPO it, a lot of billions from the market, from the IPO. And the technology is basically converting that data and all the explanations behind it. That's what the tech is. It just converts that data. So it's very simple. We're going to snazz it up before we get venture capital investment into it. That's the holy grail. That's what it is. Breaking it down into those bits: value, growth, income. Okay. And then the other parts being, well, 15 minimum, 40 pretty much maximum. Now, there's another reason for having not more than 40. What we found is people tend not to be able to manage more than 40 stocks. It goes nuts. Actually, most people can't even cope with more than that. The other thing I want to show you, by the way, I want to show you, so that's the FTSE 250. None of them meet our criteria. I just want to show you exchange traded funds. So these are exchange traded funds, right? Exchange traded funds, unlike active fund managers, have far lower fees. They tend to do a lot better. However, some can be quite risky. So we do the same analysis with this. And I just want to show you this. The only reason you'd have a fund is because you want lower volatility. See that 8%, 13%? That's a lot lower than most stocks. Just to give you a comparison, Microsoft has volatility of about 12%, and it's probably one of the lesser volatile stocks. Okay, so each one of these funds is less than that. And I'm going to show you the filtered list. That's the filter list. Okay, that's your filtered list. There's quite a lot to choose from. I don't own any of those, by the way, but some of my usually retired people, because you can see the 6-month returns, they're not fantastic with a fund with low volatility. You know, you're looking about 7%, 12% over 6 months. You might say, Alpesh, I'll take that any day. Fine, right? But we've got the Sortino above 0.3 at least, which is what I want. We've got alphas, so they're outperforming the market. That's all fine. Okay. And you can see medical devices. Okay, there's a fund for that. Is there, Alpesh? Yeah, but I don't look at the name first. That's just a narrative. That's just a story. That's a marketing gimmick that they provide. I look at the data first. But you're only really going to use funds if you're probably closer to the end of, closer to retirement in that. Anyway, top analyst, I want to show you something else. See that's from Goldman Sachs Wealth Management. Depending on where you are in your age group, we've only got about 5 minutes to go, so I'll show you how to download the stuff as well in a second. That's how much you should have.